You buy groceries, scroll your phone, fill your car, and one company profits every time. It quietly owns over 13,000 firms, managing more than $8 trillion worldwide. It built an empire by pretending to stay invisible. So how do you compete with a company that already owns the game? Every revolution starts with a moment of rejection. In 1975, John C. Bogle, a Princeton graduate and lifelong believer in integrity, was fired from his own company. He walked out of Wellington management with nothing except an idea Wall Street laughed at. The idea: stop trying to beat the market, just own it. That thought became the foundation of a system that now manages over $8 trillion. At the time, though, it sounded absurd. Brokers thrived on high fees and flashy promises. Investors paid for confidence, not logic. Bogle called it a con. In investing, you get what you don't pay for, he wrote later, flipping the system's logic on its head. His answer came in 1976, the first index investment trust. It pooled small investors' money and simply tracked the S&P 500. No superstar managers, no predictions, just math. Wall Street mocked it, calling it Bogle's Folly. One magazine even joked it was like giving up on baseball and just watching the scoreboard. But slowly, numbers told a different story. By 1984, index funds were outperforming 75% of active managers. Over time, data became undeniable. Bogle's simple idea, low cost, broad exposure, long-term patience, crushed the industry that once laughed at him. Therefore, while Wall Street shouted louder, Bogle's quiet method grew faster. By 1990, millions of retirees, teachers, and small savers had joined his Folly. His company operated under a unique structure, owned by its investors, not outside shareholders. That meant no stock market pressure, no need to chase quarterly profits. Every dollar saved on fees went back to the people who invested. That was revolutionary. Yet success brought a hidden shift. The more people trusted his system, the bigger it grew. By 2025, the same model designed to remove power from Wall Street had concentrated it into one colossal network. A quiet empire built on passive ownership, where trillions move without a single word being said. And as the money multiplied, a new question started spreading through finance. Who controls the controller? That question leads us straight into the web of silent ownership that now links every company we know. Every market move, every company announcement, every brand you see, all lead back to the same few invisible hands. Over time, Bogle's simple idea of owning the whole market created a network of ownership so wide that it now stretches into almost every corner of the global economy. By 2025, the index model controls over $15 trillion. That means one group of funds owns pieces of more than 13,000 companies, including the biggest names in tech, energy, retail, and banking. Therefore, when one of these funds grows, it quietly grows inside nearly every company at once. You might think your shares make you a shareholder, but in truth, your vote often flows upward into one single power. Take the top 10 companies in the S&P 500. The same few institutional investors hold large stakes in every one of them. They're not competing the way people think, they share owners. When Apple and Microsoft rise, the same groups benefit. When Pepsi and Coca-Cola fight for market share, the profits often go to the same portfolios. It's not a conspiracy, it's structure. In 1980, no firm owned more than 2% of any major corporation. Today, some hold over 15% of America's biggest public companies. That means decisions about CEO pay, mergers, or political lobbying are influenced by the same small circle of asset managers. However, they rarely appear on screens or make public statements. Their meetings happen quietly, far from headlines, inside offices that control trillions. Even more surprising, their reach goes beyond corporations. These funds manage pension money for teachers, soldiers, and public workers. They fund government debt. They buy real estate. So when a nation's economy rises or falls, part of that movement flows through the same invisible web. Therefore, competition in today's market looks real, but in many ways, it's a loop. Different brands, same owners, repeating endlessly. And inside that loop, something even stranger took over: money that moves by itself. There was a time when investors studied balance sheets, read newspapers, and made phone calls before buying a stock. That world ended when algorithms arrived. Now, money moves by itself, guided by machines that never sleep, never hesitate, and never feel fear. By 2024, over 70% of global stock trades are handled by computer programs. These systems don't wait for news, they predict it. They scan millions of signals, tweets, headlines, price movements, and react in milliseconds. Therefore, when you read a market story, the machines have already traded on it. One of the biggest players, Aladdin, runs on more than 20,000 servers, analyzing billions of data points daily. It watches everything: corporate debt, stock risk, weather trends, even political events. Its reach covers over $21 trillion in assets worldwide. A single update from Aladdin can move more money than entire national economies. High-frequency traders such as Citadel, Virtu Financial, and Jane Street profit from speed. They place and cancel thousands of orders in a blink, earning tiny profits that add up to billions. In 2010, one algorithmic glitch triggered the flash crash, wiping nearly $1 trillion in minutes before bouncing back. That event revealed a hard truth: humans no longer drive markets, they follow them. However, these machines rely on data, and data never stops growing. Every price, click, and trade feeds the next calculation. Therefore, the system constantly learns, adjusting faster than any regulation can keep up. When volatility rises, machines amplify it. When panic hits, they spread it instantly. But here's the twist: the same companies that run these systems also own large parts of the markets they trade in. It's like referees playing the game they're supposed to oversee. This digital speed created a new world order in finance, one where control belongs to whoever holds the data pipeline. And that leads straight to the empire selling access to that data, the unseen marketplace behind every trade. Every market move begins with one thing: information. Before a single trade happens, someone decides what price the world gets to see. That decision is worth billions every day. Therefore, those who control data don't just report the market, they quietly shape it. In the 1980s, Michael Bloomberg realized traders were flying blind without reliable, fast data. His answer became the Bloomberg terminal, a glowing black screen that combined market prices, breaking news, and instant messaging. At first, it was just a tool. Today, it's an empire. More than 325,000 terminals sit on trading desks worldwide, each costing around $25,000 a year. That means Bloomberg earns nearly $9 billion annually from information alone. But Bloomberg isn't alone in the race. Refinitiv, now owned by the London Stock Exchange Group, gathers data from 500 exchanges and 2,000 sources, processing millions of updates per second. Then there's Intercontinental Exchange, ICE, the same company that owns the New York Stock Exchange. ICE sells the very data its own markets produce. Every chart you see, every quote that flashes on your phone, flows through one of these firms first. Milliseconds decide fortunes here. When a firm gets data even a fraction of a second sooner, it can profit before anyone else reacts. Therefore, speed has turned into currency. In 2011, traders paid millions to lay a fiber optic cable between Chicago and New York, just to save 3 milliseconds. That's how valuable time has become. However, data power goes beyond price feeds. Credit rating agencies like Moody's, S&P Global, and Fitch can raise or crush a country's economy with a single downgrade. When Greece lost its investment-grade rating in 2010, its borrowing costs exploded overnight, and markets across Europe followed. So while everyone talks about money, the real game runs on information. who controls it, who pays for it, and who gets it first. And when chaos breaks out, these same data pipelines become the lifeline that keeps the system breathing. Every financial crash starts with different headlines, but it always ends with the same phone calls, between the same people, sitting on the same advisory boards, moving the same levers. Therefore, what looks like chaos often turns out to be coordination. In 2008, when the housing bubble collapsed, panic spread within hours. Global markets froze, and credit disappeared. Yet before the weekend ended, the Federal Reserve, the European Central Bank, and a network of asset managers had already begun wiring money back into the system. The U.S. government approved $700 billion in bailouts, and major investment firms were hired to manage those rescue programs. Some of them earned hundreds of millions in fees while advising the same companies they helped save. Then came 2020. Markets crashed again, this time from a virus, not mortgages. Within days, central banks injected over $6 trillion to stabilize global markets. Programs with names like liquidity support and credit facilities quietly sent waves of cash into corporate bonds and stocks. And who managed those operations? The same few firms that already owned much of the market. Therefore, the rescuers were also the beneficiaries. Even in 2022, when inflation spiked and bond markets shook, the same playbook unfolded. Emergency coordination, swap lines, stimulus. Every time, the same circle of institutions guided the response. They sat on panels with regulators, advised governments, and then returned to running their funds. However, the public only saw the recovery, not the structure behind it. The same network that manages retirement savings also helps design economic rescue plans. This overlap blurs the line between private power and public duty. It's not corruption, it's architecture. Every crisis has its heroes and villains, but in finance, they often share an office. And after every rescue, one question remains unanswered. If this network can stop collapse, what happens if it ever decides to let go? Power used to live in vaults, inside buildings made of stone and steel. Today, it lives inside servers. Money, code, and government policy now run on the same operating system, one that no single person can turn off. Therefore, control no longer looks like a throne. It looks like software. After 2010, governments began testing digital currencies, calling them faster and safer. China led first with the digital yuan, now used in more than 260 million wallets. The European Central Bank followed with its plan for a digital euro. Even the U.S. Federal Reserve studied its version, the FedNow system, allowing near-instant transfers between banks. These moves sound technical, but together they mark the birth of programmable money. At the same time, cryptocurrencies promised freedom from control. Bitcoin's vision in 2009 was simple. No middlemen, no central authority, but over the years, large investors and the same financial giants entered the space. Today, over 80% of Bitcoin's supply sits in the hands of institutions, funds, and a few major exchanges. Therefore, decentralization began to look centralized again. The same trend hit stock markets. Tokenized assets, digital bonds, and blockchain-based funds turned markets into code. In 2023, over $500 billion in assets were represented digitally. That shift made markets more efficient, but also easier to track. Every trade, every loan, every movement now leaves a record, stored, analyzed, and used for prediction. However, what looks like transparency can also mean total visibility. The same network that processes trades can trace every transaction you make. Therefore, control doesn't hide in secret rooms anymore. It hides in plain sight, buried in algorithms that learn what to allow and what to block. And this brings the story full circle. A single idea meant to give investors freedom built a machine that now touches every financial decision on Earth. So the real question left is simple. When a network becomes too big to fail and too smart to stop, who gets to press pause? Every story of money hides a deeper layer of control. If you found this one eye-opening, subscribe and stay close. The next film uncovers who quietly decides the world's next collapse.